Hey folks, it's your friendly neighborhood Dividend Uncle back again. Today, I just want to do a quick update on something that's been driving the recent rally in Singapore REITs, up a solid 11.6% over the past month. This surge has largely been fueled by increasing expectations that the US Fed will cut interest rates by 50 basis points, instead of 25, at their next meeting on 18th of September. But before we get too excited and pop open the champagne, let me share a potential risk that we should all be aware of. Don't get me wrong, I'm long in REITs and I'm not selling. I'm fully invested, but there's something about this 50 basis points cut that we need to talk about. So sit tight, because I'm going to walk you through why this isn't a guaranteed outcome, and what it means for us REIT investors. The market's expectation of a 50 basis points cut. Right now, the market is factoring in a 69% chance of a 50 basis points cut, up from just 30% a week ago. This optimism has fueled the REITs rally we've seen lately. And why not? A deeper rate cut would mean lower borrowing costs for REITs, potentially boosting their earnings and, of course, the dividends we all love. But here's the catch: a 50 basis points cut isn't locked in. While it sounds attractive for investors like us, many experts are cautioning against the Fed starting off with such a large cut. Why? Because cutting by 50 basis points at the start could signal that the US economy is in worse shape than we thought, and that's not exactly the confidence booster we're looking for. What if the Fed only cuts by 25 basis points? So what happens if the Fed only cuts by 25 basis points instead of the 50 basis points everyone's now hoping for? Well, we might see some disappointment in the markets. The REITs rally we've enjoyed could stall, or worse, reverse slightly as expectations get adjusted downwards. Remember, this recent surge is based on speculation. If reality doesn't meet those expectations, we could see a short-term dip. And while that's not a reason to panic, it's something to keep in mind if you're planning on entering the market now, at these elevated prices. Be aware of what's already been factored in, and the risks that come with it. The Dividend Uncle's take. Now, just to be clear, I'm not suggesting you rush out to sell your REITs. Like I said earlier, I'm long in REITs and holding tight. I believe in the long-term value of these investments, especially as we look beyond short-term interest rate movements. But the point I want to make today is that we need to be cautious when markets start pricing in high expectations like this. If the Fed decides to play it safe with a smaller cut, we might see some short-term volatility. That said, I'm here for the dividends, and in the grand scheme of things, I'm not too worried about these short-term fluctuations. So that's it. Just a quick update to keep you in the loop of the potential risks. I'm of course still rooting for a 50 basis points cut, but just remember that we're here for the long-term dividend income. See you next time.